The Trump Tax Act is largest tax act since the Reagan era to pass. So there are a lot of impacts all over the tax code. We're going to talk about as much as I can get crammed in here in the next 45 minutes or so. I've got my contact information on these slides. Please call me. We don't charge for phone calls, so give us a call if you've got a question. We'll even help talk with your local CPA if that's necessary. But one of the first things I want to talk about is a change to C corporation rates. If you're a C corp, the Act introduces a flat 21% corporate tax rate, which eliminates the current graduated rates of 15 on the first $50,000, 25 on the next 25 grand, and 35% on income above 75,000 up to 10 million. Despite the cut in rates, dealers should not rush to convert to C Corp status, and there are many factors to go through in making that analysis. We'll talk about that in a little bit as well. Okay, and the reason that I say that dealers should consider the change, but what in essence happened, and we'll talk about why this happened in a few minutes, but so you got C corp rates that are taxed, and then if you want the money out, you got a double taxation on it, so you end up paying more. S corp, you only pay one rate of tax. The C corp rates were reduced. The S corp rates were reduced as well. So basically everything came relative to one another in most circumstances. There will be some exceptions to that possibly, but this is one of the most frequent questions that I've gotten from dealers is should I make this kind of change? The S corp, in case we don't have time to talk about it, the S corp rates were modified instead of Congress doing the easy thing and saying, hey, individual rates have dropped on your S corp income. They decided to say 20% of your income from in your case, dealerships or from your businesses is not subject to tax. So you have a 0% tax rate on the first 20% of income that you make, and then the regular rates kick in for the rest of the 80%. Effectively, that drops the rate by about 9 or 10% from a practical standpoint there. Okay. And I've worked through an example, and anybody that wants the slides, feel free to send me an email because I'm happy to share the slides. But I worked through an example of C Corp after the reform and S Corp after the reform, and you see the effective rates, even though the published rates are lower, you end up with an effective rate of almost 54% on the C Corp, whereas it's effectively 38.8, 39%. And again, one of the variables is which state you're in, and so forth. So, okay. Corporate, the AMT, the alternative minimum tax. The individual AMT, alternative minimum tax, still exists, but most of the deductions that trigger AMT have been eliminated or modified. Exemption amounts for joint filers were increased, but overall the corporate AMT has been repealed for this year and beyond. The AMT is the alternative minimum tax, and that goes back, since I'm naming presidents, that goes back to the Nixon era, okay? And it really was established for, you've read in the papers where these big companies that don't pay any taxes, right? Well, the AMT was set up so that every business is going to pay tax, okay? And it was established in, as I say, back in the 70s. The alternative minimum tax, if you're substitute or have paid it, it creates a credit going forward that you can use against your regular tax. Those credits, the use of those credits have been accelerated, and so we're going to be able to claim refunds there. It's a good planning opportunity. Those of you that have paid AMT in the past may be overpaid this year on your taxes. So we're finding that in some cases. Business interest. limitations. Okay, I did something back in November that I'd never done before, and to be honest with you, it was really cool and it was really scary. I actually testified. I was called by the various of the state and regional dealer associations. I see Ralph from Northeast in the back there. That was one of the associations, as well as the National Association. They asked me to basically speak with the Ways and Means Committee. So I kind of testified before the committee by phone. And it was on this topic specifically, and we were successful in doing that. Like I say, it was really cool, a little nervous, but it was really cool. So the general rule is that every business, regardless of what type it is, okay, is going to be subject to limitations on the deductibility of interest. And it's basically a 30% limitation based upon adjusted taxable income. All right. This proposal, if we hadn't been successful with Congress, would have significantly limited the deductibility of your floor plan interest with all your interest for dealers. As a matter of fact, we did one of the examples that I presented to Congress was, or to the Ways and Means Committee of Congress, was a dealer that made, and I'll do round numbers here, I had the exact numbers on the phone, but he made about $100,000, had $100,000 of taxable income last year, let's say, okay? But to get to that, he paid about, as I recall, $700,000, almost $800,000 in interest expense, floor plan interest to get there, okay? So if that isn't deductible, that $800,000 is not deductible, okay, he's going to pay tax on a much bigger number. Now, the way the math works is you take the $100,000 of taxable income, you got $800,000 of interest, you add those together, that's $900,000, okay? You get to deduct 30%, up to 30% of that number. So let's do the math. Let's say it's $300,000, just to keep it simple. It's $270,000, but let's say it's $300,000. $300,000 is what we get to deduct, right? Well, I had $800,000 of income, or interest. I only get to deduct $300,000. That means I'm going to pay tax on an additional $500,000 that I don't have. I paid to the bank. So instead of my taxable income being $100,000, my taxable income's $600,000, and I owe more in tax. This dealer actually would have owed more in tax than what they paid than what they made in the year. Okay, bad scenario. And so we were successful in getting a carve out for dealers and preserving the deductibility of floor plan interest. Now there's a little trade-off on that. Well, first of all, there's a carve out to the carve out. Okay, construction equipment dealers. Construction equipment dealers do not get the benefit of this carve out. So they're still subject to that funny math that I just did, okay? Other dealers, okay, other than drug dealers, other dealers do get the benefit of the carve-out. So we preserve that for them. The jury's still out. There are still questions as to how do we deal with, for example, if you sell, in addition to your normal equipment, you sell skid steers. Skid steers are under a construction equipment contract typically. So what do we do with that? Are we a construction equipment dealer or are we a non-construction equipment dealer? Okay? We've got some rules. Just if you're in that situation, give me a call. Have your accountant give me a call. We can walk through it. There's some old case law that we're going to rely on to benefit you as we go forward. And then there's some other questions because we work with quite a few timber equipment dealers who sell timber to the timber industry. Well, that's not construction equipment, but it doesn't fit nicely in the other definitions either. So we've got some things that we've got to work through as we do with all new tax laws as they become effective. Okay, so I walked through how adjusted taxable income basically is calculated. Any disallowed interest for those dealers that would be subject to this, we do get to carry that forward And just bear in mind that this applies to your floor plan interest. You get to fully deduct your floor plan interest. Other interests you do not. So earlier this week, I met with a dealer up in Indiana, in Terre Haute. Any of you know where that is? I met with a dealer in Terre Haute, and they've got a significant amount of their equipment they own free and clear. They have loaned money individually to the company, okay? That's a related party note. Unless we change the terms of that note to make it look and feel and smell like a floor plan loan, that interest is not going to be deductible at the dealership level. But guess what? It's still taxable income at the individual level. That's not fair, right? Not fair at all, okay? So we got to work through these things. And we need to re-look at all of the related party loans, whether it's from you, your parents, kids, real estate entity that you own, or whatever it is, okay? So ultimately, what does this mean for dealers? There's no limit on your floor plan interest deduction. Non-floor plan interest will be subject to the 30%. But smaller dealerships are not subject to the 30% limitation. And most OPE dealers are going to fall under yet this further exception. And so the small dealer exception. I already mentioned that dealers with multiple lines who might not qualify for the carve-out need to be aware. As I said, skid steers is a good example. Okay. Now, there's a trade-off. When I proposed this to Congress, what I suggested was, hey, give the dealers the option of allowing us to deduct our floor plan interest or take advantage of the bonus depreciation, because the proposal that they had that was likely to come out was, in exchange for being able to deduct your floor plan interest, you don't get to take advantage of this 100% expensing under the bonus depreciation. So dealers, you guys don't get that advantage. If you've got a large rental fleet and you're not a construction equipment dealer, it's a problem. So for you, most of you probably aren't running a large rental fleet, but some of you may be. Okay, so our trade-off deals, so your customers are going to get to take advantage of the bonus depreciation, but you yourselves will not, because Congress didn't allow us the choice. They said, if this is your business, then you don't get to take the bonus depreciation. Okay, so the bonus depreciation in general allows businesses to fully deduct 100% of the cost of fixed asset additions, okay, if you will. Under prior law, the taxpayer could deduct additional first-year depreciation in the amount of 50% of cost in 17, and then that was going down to 40% in 18 and 30% in 19. That's all been replaced with this. What I'm telling dealers is, make this a selling tool when you get to this time of year, October, November, December. Send a notice, send a direct mail piece, contact your customers, your big professional cutters and so forth. Say, hey, you get a big tax advantage if you buy equipment. Why not buy equipment before the end of the year? Accelerate the sale for yourselves, okay? All right. In the past, the bonus depreciation only applied to new equipment that they place in service, so they can buy some used equipment from you and it'll still work, okay? All right. Let's see. Be aware of contracts written prior to September 28th of 17. So if you've got a big purchase contract or you're building a new facility and it was entered into prior to September 28th of 2017, the old rules are going to apply. I don't know that that's going to hit a lot of you, but we work with hundreds of dealers, and we've got several dealers that were in that situation where we were doing major remodels and they're under the old rules instead of the new rules, even though they didn't get finished until the new rules came into effect. Okay? All right. Here's a little summary of how the bonus depreciation rules are going to be phased out, okay? So after 2022, we get the phase outs down to 80, 60, 40, and 20% for most taxpayers. Again, you guys are excluded from it. So these, we're talking about your customers at that point. And then under the new limitation on business interest, as I previously discussed. Yes.
On the bonus depreciation, is that additional after the first 250,000 of Section 179?
Section 179 I haven't spoken about yet. Section 179 has gone up to $1 million, which helps us. That offsets not getting the bonus, right? I can go up to $1 million. So it's totally separate, and the dealers still get that. So that's about 3 slides ahead, I think, maybe 2. But yes, okay.
Still get the full, able to deduct the full amount the first year on 179.
Under 179, you're still able to deduct the full amount up to $1 million if you invest up to $2.5 million. You can deduct. Again, these are numbers that are big numbers. I realize that in the normal course of business you're not going to hit there, but we got dealers that are building new facilities, so you can hit it when it gets there. But it phases out dollar for dollar between $2.5 and $3.5 million. So you don't get the 179 if you place a big bunch in service in 1 year. Okay. Yep. Let's move forward. Okay. Okay. Kind of. Okay. In summary, new or used property placed in service after September 27th of 17. We got the ability for last year's tax returns, which you may have filed, okay, in April, okay, or may have, if your accountant didn't get the job done and extended it to October, may have just been filed. You had the opportunity to take this deduction, 100% expensing, again, if you're in a small situation where your customers do, for assets placed in service between September 27th and the end of the year. If the dealership is under $25 million in gross receipts for the previous 3-year average, you can use both the 100% bonus depreciation and not be subject to the interest limitations. Okay, so that's a good benefit for many of the small dealers. The small dealer exception there for 25 million. Next thing I want to mention is there's some new limits with regards to automobiles, okay, luxury vehicles, all right, that have gone up significantly, really, for us. And then here's Section 179. Our 179 expensing has been increased from the current $500,000 up to $1 million, okay, so anyway, as you see there, all amounts are going to be indexed for inflation.
What was that limitation on the power?
One back. All amounts are going to be indexed. There's still $25,000 limit on SUVs between 6,000 and 14,000 gross vehicle weight. All right. Okay. Section 179, the new law allows dealers to continue using 179, as I mentioned, okay, in addition to taking the floor plan interest deduction. So that's good if you're a big dealer, multiple locations, so forth. Section 179 is limited by the amount of taxable income that a dealer makes, so it could be used to offset taxable income down to 0. You can't generate a loss. The bonus depreciation, you can actually generate a tax deductible loss, okay, offset income from other sources. Okay, not the case with 179. So this 179, it's a benefit for us, but it's not a panacea. It's not as good as. The amount of the qualifying property got increased from $500,000 to $1 million, and the phase out from $2 million to $2.5 million. And the list of real property got expanded as well, which is making it much more, being able to utilize it much more frequently. Okay? All right. Real estate depreciation. Current provisions remain in effect regarding the depreciable lives of real property, which is 39 years for your business non-residential and 27 and a half years for residential property. There's some new definitions though. Separate definitions for qualified leasehold improvement property have been eliminated and replaced with a more inclusive, much more friendly qualified improvement property classification. Assets that fall into this category are depreciated using 15-year lives. Okay? Again, a big benefit if you're renting your real estate from an unrelated third party. In the past, it had to be an unrelated third party. Under the old rules, the beneficial lives and expensing could not be used unless the building was in service for at least 3 years and was pursuant to a lease with an unrelated party. These have been eliminated, making it a lot easier, a lot more beneficial. Represents a substantial new benefit. So it can be self-rented property, you get 15 years on, and you don't have to be under a lease, pursuant to a lease in 3 years, and that kind of thing. Like-kind exchange. No 3-year requirement pursuant to a lease. Okay? I'll leave that up there because some people are taking pictures. So. All right. Like-kind exchanges. Like-kind exchanges are going to be allowed for real estate only, starting in 2018. This is a major impact, can be a major impact to dealers and to your customers. And it's a significant impact to your customers in certain states. So let's talk about this. The reason that the construction equipment dealers wanted to be carved out from the carve-out on floor plan interest is because of this provision. They have we're talking some construction equipment dealers have hundreds of millions of dollars in equipment in service that they're renting. Okay, think big cranes, big equipment, that kind of thing, right? And they're replacing that on a regular basis. Currently, they do like-kind exchange treatment, which just basically they don't pay any tax as long as they take those proceeds and buy replacement equipment. Well, they're still in business, so they're doing that, right? So they continue to reinvest in the business in their rental fleet. The rules change. Like-kind exchange goes away. Guess what? You sell your equipment, trade your equipment in, sell your equipment. You're going to pay tax on that. Big deal. And you don't get like-kind exchange treatment. But the bonus depreciation, immediate expensing, can offset that, right? I'm going to spend the same dollars. I get to write it off immediately. No limitations like you have with 179. Okay, we're good. Until they start phasing out after 2022. But we'll have changes to the tax law by then, so this isn't finished. So that's why the carve-out was done. For the carve-out of the carve-out, okay? So it was a tremendous blow, potentially, to the dealers that have large rental fleets. But it goes further than that. For example, let's say you've got a customer trading in equipment that's worth, his whole fleet. Could be worth $10,000, could be worth $100,000, doesn't really matter, okay? And they've fully depreciated it. Your customer is going to have to pay tax on the gain on that, but they get to use bonus just like the construction equipment dealers could. That's great, okay? Where it becomes a problem potentially to your customers are those states that have a personal property tax. Because the states for personal property tax purposes are following along with this. There's no like-kind exchange and there's no bonus depreciation for personal property tax. So now you've got somebody who trades in a fleet of equipment. One of your cutters trades in a fleet of equipment worth $100,000 and they've owned it for a while. Okay, it's fully depreciated. It's not worth anything on their tax records. They're going to buy equipment. You're going to give them a $50,000 credit to replacing their equipment. They're going to pay you $120,000. You're going to give them a $50,000 credit. They're going to pay you $70,000. Ordinarily, we'd only pay property tax on $70,000. That customer would. They're now going to pay property taxes on $120,000. It's a big impact in certain states. Nebraska is one of those. There are a number of states, many states that have property tax laws. So bear that in mind as you're dealing with your customers. It may come up. When this was passed, we had ag equipment dealers who were calling us in December saying, what the heck? I just had a big fleet of combines that got canceled on me because of the personal property tax in my state. So it's a big deal. If you're in one of those states, work with your state to get maybe some things changed to your benefit there. Okay. All right. I think that's probably enough on that. Big thing on like-kind exchange is it's gone for other than real estate. So we talked about qualified improvement property, and we talked about real estate depreciation, like-kind exchange. All right. So cash method of accounting. Okay, and code section 263A, or the UNICAP, or Uniform Capitalization. All right. So the UNICAP, the Uniform Capitalization rules, the exception has been broadened to dealerships that have less than $25 million in total receipts are no longer going to be subject to this. Well, I got news for you. We've been not subjecting our dealer clients since the mid to late 90s to the UNICAP because I believe the way we operate, we are fully capitalizing things and complying with the law. In 2010, the IRS agreed with us. Okay, so you shouldn't have been paying Code Section 263A or tax on this clearly since 2010 anyway, but now it's just been expanded. All right, if you have been filing your return and your accountant's been subjecting you to UNICAP, you need to find out from them because they actually need to file a form with the IRS, a change in accounting method to adopt these new limits and request this. Okay? Okay. The cash method of accounting. Taxpayers that maintain inventories, which are dealers, are generally required to use the accrual method. The opportunity to use the cash method is determined by calculating the taxpayer's average gross receipts, and under the Act, the average gross receipts of less than $25 million a year. The Congress got on this $25 million fix, are going to be able to use the cash method of accounting. Be wary of that. You may ultimately not be able to because you're carrying inventory. We've got to work through that a little bit further. We've got some very, very good news with regards to LIFO. Despite threats since the 80s to eliminate LIFO, and quite honestly, almost every single one of our dealer clients is on LIFO. So if you are not on LIFO, you need to talk to your accountant about why you aren't, and we need to have a discussion. It is a non-cash deduction. You're getting to deduct the investment that you have in your inventory. You basically get to deduct that, the benefits of that. Anyway, so this is a good thing. Barry, LIFO has not been eliminated, and that is a very good thing for you. Net operating losses. The NOL, the net operating loss rules have been changed and changed very significantly. Net operating losses are now limited to 80% of the taxable income, with the remaining 20% being carried forward indefinitely. This only applies to losses generated after January 1st of 2018. Prior net operating losses are still eligible to offset 100% of the dealer's taxable income until they're used up. Okay. Prior law, NOLs were carried back 2 years and forward for 20 years. Under the new law, there's no carryback, but we get to carry it forward indefinitely until it's used. Again, you've got these 80% limitations. The qualified business income deduction. This is very, very important. The tax on Okay, and it's very complicated when you work through this. There's a whole process that we go through. What we've done is we've already done this for our dealer clients, again, hundreds of them, and because of your heavy investment in payroll, for most of you, in payroll, okay, you're going to always come out getting the 20% deduction. So when I talked earlier about this leveling of the playing field between S Corps and C Corps, where the rates came down, the first 20% was subject to a 0 tax rate. That's what I'm talking about, coming back to that. So, anyway, to shorthand this, I wouldn't worry about this too much. There are instances. I know there are some of you in the room that maybe have 1 or 2 employees. If that's the case, you may be subject to another limitation that won't get you all 20%, okay? But as I say in the final bullet, most privately held dealerships are going to be eligible for the full deduction, and the IRS is in the process of drafting some guidance for us on how to actually implement this, okay? I'll leave that up there so you can take some pictures of this if you want, very quickly. And this deduction expires in 2025, which means your rates are going to go up by 20%, okay? Because you were at a 0 rate of 20%. Got an example here of thinking through this, okay? And this box right here, if you've got a little bit of payroll, that's where you're going to end up having some exceptions, or some exceptions, okay? The limitations goes into a lot more. This is designed to be reference materials for you as you go back, because it gets pretty tight. Yeah. Okay. All right. There's an example that I think you guys should maybe take a picture of. I don't have time to go through it, but I worked through 3 examples, A, B, and C, of different dealers for you. What I'd like to talk about is, in the next few minutes, is meals and entertainment, your deductible meals and entertainment expenses, because this is another change to the law, and it's significant. There's no longer any deduction allowed with respect to entertainment expenses. So the tickets that you buy to take a customer out to the ball games, to take them to the golf course, to take them on a hunting trip, fishing trips, those types of things, 0, goose eggs, nothing, no deductibility. Those were deductible in the past. We typically deduct them as advertising or promotion and so forth. And there is clearly black letter law, no deductibility for this. We had a 50% deductibility for meals and entertainment expenses, so we were deducting half of it in the past. This also applies to most of the meals that you were have been incurring. So expenses for entertainment, amusement, and recreation are no longer deductible. Again, the trips, the hunting trips, the games, and so forth. For amounts incurred and paid after December 31st of 2017 up until 2025, through 2025. Provision limits the deductibility of expenses associated with providing food and beverages to employees through an eating facility. So if you provide the meals and for the convenience of the employer, no deduction is permitted. What we oftentimes see are, we as a courtesy will order pizza on Saturday, or we bring meals in for the employees. No longer deductible, guys. That just changed, okay?
I have a question.
Yes.
How does that apply? We have our own truck driver that goes out and picks up our freight, and we pay him per diem. He's an employee. We do per diem allowance. Is that just allowed in law?
The per diem, if it's out of town travel, for example, you coming to this event, okay, if it's tied to an education, can't just be a trip to go to, hey, I want to go down to Naples, Florida, okay? got to be a business reason to it. You're still going to have some deductibility for that. I'm sorry?
If you do go to Naples, we'll sell you a mower.
We'll sell you more. There you go. There you go. Are you in Naples?
Yes.
Okay. Very good. I didn't know that. Yes.
Are those still subject to 50%?
Correct. Correct. Yep. 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 So you've got some benefit. You've got some wiggle room, but it's really tightened up tremendously. Okay. That is what I want to kind of put out there for everyone. Okay. A couple of other miscellaneous items as we're approaching the last few minutes here. Electric vehicles are becoming more and more prevalent, right? I doubt that many of you have purchased electric vehicles, but they're becoming more and more prevalent. Those credits, the current credits are retained if you buy a vehicle personally. If you buy a vehicle for your business, that's an electric vehicle. Okay. The Affordable Care Act, Obamacare, the mandate to purchase health insurance is repealed, along with the related subsidies, but dealers are still responsible for the Medicaid surtaxes and the additional 0.9% Medicare tax on wages. So that's still in place, even though the Affordable Care mandate is gone. The act has also created something new. It's a new credit relative to paid family and medical leave, okay, for those dealers who voluntarily pay wages to qualifying employees who are on Family and Medical Leave Act. Credit ranges from 12.5% to 25% of the wages paid for on the leave. Currently, you don't have to pay them. You have to give them leave. You don't have to pay them while they're on leave. If you voluntarily pay them, you can create a tax credit. We have instances where some dealers will decide, you know what, Sally Sue's a valued employee. I want to take care of Sally Sue. She's off. It's a bad deal. She's sick. She'll be back. I'll take care of her. If it's a voluntary situation, make sure your accountant knows that there are some tax advantages or a credit that you can get for doing that, but it has to be voluntary. It can't be court ordered. You can't lose a suit to them. You know, those kind of things. All right. I want to open the floor up for a couple of questions. We've got like 3 minutes for questions, so I'm kind of opening up for that. I've got some other slides. I'm going to pass through the slides so that those of you that are taking pictures, again, if you want, it's easier. I'll email the slides to anybody. So, because this slide deck is like, I don't know, 50 slides or something. So, there you go. Any questions from the floor? And it's hard for me to see. All right. Yes.
On the 179, did I understand that new roof is now is deductible this year?
It does qualify under 179. That's correct. It may have qualified in the past under the capitalized regs, which have been in place since 2013 or 14.
But it's 100% deductible first year now?
Well, it can be.
Okay.
Depends on how much you're spending and how much you're spending on other things because of the limitations and so forth. So that fall in. As you can see, I've put some slides in here for everybody to reference on their individual tax reform act as well, or the individual taxes and reform act as well. So, anyway, just going through those. Okay.
And what is LIFO? I'm not familiar with it.
LIFO stands for last in, first out. Basically, under LIFO, we deduct, it's a math problem, but there's inflation every year, right, on your equipment. And we deduct it's a non-cash deduction, so you've got an investment in your expenses anyway, or in your inventory anyway, and we'll take a deduction for the inflation on that in the current year. And it's a benefit. It's not cash benefit. And again, if you've got an investment in that inventory anyway, why not take advantage of it? Okay. The last slide here is my contact info. Feel free to contact us. We don't charge for phone calls now. If we get on the phone for more than an hour, you got a bigger problem, you know. So break it up into multiple calls. How's that? For an accountant, I'm not very good at counting, am I? But anyway, this wraps up this session. It certainly didn't cover everything. It can't, okay? But I wanted to at least give you a flavor of some of the big things that are impacting you or impacting your customers. One of the things that I recommend, and I mentioned it earlier, and we've been doing this for our clients for years, is we've been drafting a letter that deals with the depreciation rules and the 179 and bonus that our dealers are actually taking and using and folding it into a promotional piece that they can send to their customers and say, hey, here are some benefits. And because it's written, if you will, the guts of it, the technical pieces are written by the CPA, it's like, hey, we had this written by our CPA, so you got some confidence that it's right, if you will. So again, I encourage you that. Revenue's revenue, right guys? So, all right. Okay, I'll be here. I'll be out at the EDA booth right outside here for a while if anybody wants to come by and see me or you want to come talk to me now.